Welcome to the JRD Solution YouTube channel, where financial education meets real transformation. Many people use credit every day without fully understanding how it actually works. They swipe credit cards, apply for loans, and make monthly payments, but still struggle with poor credit scores and financial stress. The truth is, credit can either become a powerful financial tool or a financial trap, depending on how you use it. In today's video, we're breaking down how credit really works, why your credit score matters, what affects it the most, and how you can start building stronger financial habits for long-term success. Because once you understand how credit works, you gain the power to change your financial future. Number 1. What is credit? So first, what exactly is credit? Credit is the ability to borrow money and repay it later. When banks or lenders give you a credit card, loan, or financing, they are trusting that you will pay the money back responsibly and on time. Your credit history becomes a financial reputation. It tells lenders how trustworthy you are when it comes to managing debt and financial obligations. Every payment you make, every balance you carry, and every account you open contributes to that reputation. The stronger your financial behavior, the stronger your credit profile becomes. Good credit can open doors to homes, cars, businesses, lower interest rates, and financial opportunities. Bad credit can make life much more expensive and stressful. That's why understanding credit is so important. Number 2. What is a credit score? Your credit score is basically a numerical summary of your financial behavior. It helps lenders quickly evaluate how risky or responsible you may be as a borrower. Most credit scores range from poor to excellent. A higher score tells lenders you manage debt responsibly. A lower score may signal financial risk. But many people don't realize their score impacts much more than loans. Your credit can affect apartment approvals, car financing, business funding, insurance rates, and sometimes even job opportunities. That's why improving your score is about more than just numbers. It's about increasing financial freedom and access to better opportunities. Understanding what affects your score is the first step toward taking control of your financial future. Number 3. Payment history. One of the biggest factors affecting your credit score is payment history. Simply put, do you pay your bills on time? Late payments can seriously damage your credit because lenders see them as signs of financial instability. Even one missed payment can remain on your report for years. That's why consistency matters so much. Making on-time payments shows lenders that you are financially responsible and dependable. Whether it's a credit card, car payment, student loan, or personal loan, payment behavior builds your financial reputation over time. Many successful financial journeys begin with one simple habit: paying bills consistently and on time. It may sound simple, but it's one of the most powerful things you can do for your financial future. Number 4. Credit utilization. Another major factor is credit utilization. This means how much of your available credit you're actually using. For example, if your credit card limit is $1,000 and you spend $900, your utilization is very high. High utilization can lower your score because lenders may think you're financially overwhelmed or too dependent on credit. Experts often recommend keeping utilization below 30% whenever possible. Responsible credit usage shows financial discipline and balance. Many people mistakenly believe maxing out cards helps build credit faster, but the opposite is usually true. Managing balances wisely is one of the fastest ways to improve financial health and maintain stronger credit scores over time. Smart credit usage creates stability and confidence. Number 5. Credit history and account age. Length of credit history also plays an important role in your score. Lenders like seeing long-term financial responsibility. Older accounts help show stability and experience managing credit over time. That's why closing old accounts can sometimes hurt your score instead of helping it. Many people think closing unused cards is always smart, but older accounts may actually strengthen your financial profile. Your credit history tells a story. The longer you demonstrate responsible financial behavior, the more confidence lenders may have in you. Building strong credit is not about quick shortcuts. It's about consistent habits maintained over time. Patience and discipline are key parts of financial growth and long-term credit success. Number 6. Hard inquiries and new accounts. Every time you apply for new credit, lenders may perform a hard inquiry on your report. Too many inquiries in a short period can lower your score temporarily and make lenders cautious. Why? Because applying for multiple accounts quickly may signal financial stress or risk. That's why it's important to apply for credit strategically rather than emotionally. Some people constantly chase new credit cards, hoping to solve financial problems, but this often creates more debt and financial pressure. Responsible financial planning is always more powerful than impulsive borrowing. Before opening new accounts, it's important to understand your goals, your budget, and your ability to manage additional debt responsibly. Smart decisions today create stronger financial opportunities tomorrow. Number 7. Common credit myths. There are many dangerous myths surrounding credit. Some people can reply with recording BIMEs, but there are many dangerous myths for more middle credit myths. Something that could be ability before, there are many dangerous myths surrounding credit. Maybe that's 7% your goals. Some people believe checking their own score lowers it. Others think carrying debt helps improve credit. Some even believe credit repair happens overnight. But real financial growth takes education, patience, and consistency. Understanding how credit actually works allows you to make smarter decisions instead of emotional decisions. That's why financial literacy is so important. At JRD Solution, we believe knowledge creates empowerment. The more people understand financial systems, the more confidently they can build wealth, reduce stress, and create opportunities for themselves and their families. Financial education is one of the most valuable investments anyone can make. 8. Building a better financial future. The good news is this: credit can improve. No matter where you start financially, consistent, positive habits can help rebuild your score and strengthen your financial future over time. Better credit creates access. Access to homes, access to lower interest rates, access to business funding, access to financial flexibility and opportunity. But strong credit is only one part of a bigger picture. True financial freedom comes from understanding money, managing debt wisely, planning strategically, and creating long-term stability for yourself and future generations. At JRD Solution, our mission is to help individuals and families gain that knowledge, confidence, and financial control. Because financial freedom begins with understanding how money works. Now that you understand how credit really works, you can begin making smarter financial decisions that move your life forward instead of backward. Remember, credit is not just about borrowing money. It's about building trust, opportunity, and financial freedom. If you're ready to strengthen your financial future, improve your credit knowledge, and continue learning powerful financial strategies, visit our website today, www.jrdsolution.com. And don't forget to subscribe to the JRD Solution YouTube channel for more videos about credit, taxes, entrepreneurship, business growth, and wealth-building education. Thank you for watching. Educate, empower, execute.